Morning, everyone. Welcome to a new week and to the morning call, 20th of July, Monday. I'm Mark Gardner. So combination of factors, China AI model being released, Kimi from China's Moonshot, over leverage, and the war sees the market head lower on Friday and probably lower in the end of the day here. Now we've got Nvidia, Google, Microsoft, Meta, Tesla all down fairly considerably. And we got, basically the overall market heading a hell of a lot lower, basically due to the SOX index overall. The SOX index actually hit a bear market territory on Friday. It's down 22% from its low. From its high on, back sort of, I think about a month and a half ago. And as you can sort of see, some of these names, Micron was only down a little bit, but AMD, Broadcom, Intel, and obviously Nvidia being the big one, sort of sending things a little bit lower. And overall, there's a high amount of leverage there at the moment. That's probably going to, it could potentially snowball this thing overall. Nikkei was obviously the biggest loser last week. You've got China heading lower as well, but see that NASDAQ, that's the NASDAQ 100. I think the NASDAQ composite, that is. The NASDAQ 100 was down nearly 3% last week. So look, the triple leverage semiconductor ETFs lost more than half its value since its June peak. And look, what triggered that was this Chinese AI startup Moonshot. They unveiled their Kimi K3, a 2.8 trillion parameter model, which the markets initially treated as a bit of a DeepSeek moment, and it's broadly negative for tech overall. And it's already beating some of the best of America's large language models, etc. And it isn't just a bigger model; it's sort of proof that the AI industry in China is really closing the gap faster than anyone expected. And it's open and name only. Running it yourself would probably cost you hundreds of thousands in hardware, but it's a bit of a flex aimed at enterprises and rivals. It's not really going to be available to the broader retail market. And this is obviously of concern here. This SOX hitting bear market territory. There's, as I say, it's really a lot of the leverage that's pushing this down, I would say. So we've got leverage ETFs and margin debt going absolutely vertical. Traders have piled into leverage bets on the ETFs, which have gone up 200 billion in the last 3 months. And then you've got on top of that the FINRA margin debt, which is where there's actual borrowings with brokers, has basically gone from about a trillion to 1.4 trillion in about 6 months. These periods where we see margin debt and leverage go vertical for retail particularly very much coincide with a lot of market pullbacks, and it's a very, very, very reliable signal that the market's getting a little bit ahead of itself. So US-Iran conflict's also escalating pretty badly as well. As you can see on the top, the chart there is that's the traffic is basically back to zero here at the moment. Chart in the middle there is the US oil reserves. They're at 40-year lows, and you can sort of see here that dotted line there is troop movements and the escalation. So we're basically, the MOU's now broken completely. There's attacks every day now. We had 2 US soldiers killed on the weekend, and one's missing. So we would expect some broader escalation, and that's obviously we got here US and troops were starting to de-escalate, but that trend's starting to move up a little bit higher there on the bottom chart as well. So we're at 90 days to getting anywhere near normal supply, and look, I would say Brent and those, and oil and things will start to head a hell of a lot higher. As I think we've seen almost in the last sort of 15 minutes, I think we've opened up around about 2 or 3% in oil there overall. So yeah, those sorts of combinations are not very good for markets overall. And I really do think that we're in for we're in for a little bit of a poor week, and we've seen the likes of crude obviously head up higher. We've seen lithium and uranium head a little bit lower. In this situation, I think that those lithium and uranium will be great long-term plays. They're probably not bad buying in the long term. We saw but we saw gold and silver head a little bit higher on Friday, just as the US dollar finished down for the week, and starting to worry whether obviously another wave of higher oil prices might not only obviously bring in inflation, but dent the consumer pocket overall. We did have a consumer sentiment, Michigan consumer sentiment survey on Friday that was a fair bit stronger than normal. So that's actually probably not a bad result for gold and silver overall. It's a bit of an odd move compared to what they've been doing lately. This week overall, we're going to have a few tonight, like Starbucks, etc. That'll be maybe a decent insight into the consumer. We've got Alphabet and Tesla. That'll be Wednesday morning, Thursday morning, and some other pretty important ones like GE Vernova, Freeport McMoran for copper, Eli Lilly and Intel and RTX. We got healthcare, chip stocks and defense stocks there. So fairly decent sort of full calendar, and then employment will be Thursday here in Australia. That's obviously US time here on this calendar, and we've got some flash PMI as well. But overall, it's a fairly big week this week in terms of the capex guidance being the number for Alphabet and Tesla. They'll probably be the two best ones because Tesla's already renting out. It's renting out a fair bit of its compute to the likes of Anthropic, and it's well ahead. And Alphabet's been has been spending, but not it's been doing a lot on the inference chip front, etc. as well. So it'll be interesting to see, like I said, GE Vernova from the power bottlenecks perspective, Freeport McMoran from the copper perspective, and then Intel from the chip maker. Intel's up an enormous amount, and I dare say RTX Corp will probably go pretty well, given this escalation and continuing conflict in US and Iran. So there's been some pretty major strikes go on over the course of the weekend. Some aimed at Israel as well. We bring Israel back into this, and it probably becomes a bit of a crap fight again. But we went into a fair bit of this on bulls versus bears for the chip stocks on Friday. For those of you who don't listen to it, you should get to it. It's a little bit of an extended thing. Myself, Finn Judell, Kai Chen, our resident AI and chip expert, just going through what we essentially is it time to abandon. We did a bearish one the previous week as well, which was pretty timely leading into this. And if you scan the QR code or go to mpcmarkets.com.au/podcasts, you can subscribe on your favorite platforms, Spotify, YouTube, Apple Podcasts, iHeartRadio, etc. This one sort of gives you a bit of the lowdown on which ones to probably buy on the dip. If in the event that we do have a short, sharp pullback, which, with that leverage is highly possible and highly probable, I would imagine, overall. So, and we've got a strategy around this as well, mpcinvest.co/buy the dip, or go to our websites on the homepage, scan the QR code, S&P 500 index investment, but basically the nominated weekly day up until November will be your entry price for the next 3 years. If you're holding any S&P or FANG or NASDAQ ETFs, this is definitely worth looking at. It's capital efficient. You've only got to put down about a fifth of the amount of capital, and it optimizes the entry over the course of the next 4 months, which is likely to be pretty rocky, I would imagine. And then you don't really have to guess the low. You get the strategy to do the work for you overall. So, if you're a little bit worried about where the market is and where we could possibly go, particularly coming into the midterms, which has a pretty reliable downturn, scan the code, go to the website, have a look. It's for retail and for wholesale investors. So you know, if you're holding some of that stuff, it is definitely worth having a look at overall. I think the SPY will probably open up largely flat. I think it was a little bit up on Friday night. But I think this escalation over the course of the weekend and higher oil prices will probably see this thing, you know, potentially, you know, dip on the open. So yeah, there wasn't much corporate news this morning, and we're not going to be too affected by this chip rally, this chip sell-off, just because we're not, you know, we're not very chip centric. So yeah, we've currently got WTI crude at $84, up 3%, and I would imagine that will continue to head higher over the course of the day, and there'll be some selling in the Asian markets, particularly in the Kospi. I dare say it'd be a ripe day for there to be some form of circuit breaker. So, but have a great day, people, and we will speak again tomorrow.